I think, yes, central banks are, the main players in the markets today, so it's very important to watch what they're doing.
Roberto, thank you so much for joining Dukascopy TV again. It's a pleasure to have you in our studio once again. We're going to talk a lot about the central banks today, different issues. So let's start with the Fed. What would you expect to see from them moving forward? Are we likely to see any more rate hikes this year?
Happy to be back at Dukascopy TV. And I think, yes, central banks are, the main players in the markets today. So it's very important to watch what they're doing and what they're saying, and then to make interpretation. I think that global economic activity is picking up and is more sustained. But central banks' economic policy and monetary policy are still very accommodative. Fed, which has been the first central bank who start normalizing interest rates, have been raising interest rates steadily but slowly in the last 6 months. And now all the question is what's going to be forward. I think that they are still on a prudent path. Even if they expect 7 rate rise in the next 2 years. And this is absolutely not discounted by the market, who is only betting on 3 interest rates hike in the next year and a half. So, I mean, this is what could cause some turbulences in the market. I still feel that there is another important issue is about the unwinding of the balance sheet, of the huge balance sheet that the Fed accumulated in these past few years. And this is an open question, how markets will react and if there will be any disruption. So I think that it's correct that Fed try to normalize the situation, especially in a moment when markets are pretty calm. I think they are still behind, and they want to be absolutely sure that the economic situation will keep improving, but now we are at full employment. I think that the Trump economic program, even if delayed, will kick in, so this will be an additional stimulus to the economy, and an economy that is creating more than 200,000 jobs on a monthly basis with the employment rate of 4.5%, of course, will create down the road some inflation, plus all the economic stimulus and money that is, absolutely in the system. Now the question is always about timing. And I think the Fed, like other central banks, are still, pushing, and so the risk could come on the other side if all of a sudden, inflation, which is always a lagging indicator, will start to kick in. Then we'll have to see how fast or how far they should move with interest rates.
Mm-hmm. So you mentioned other central banks there. Let's move over and have a little look at a couple others, starting with Japan, where the governor, Haruhiko Kuroda, has been fairly upbeat recently. Do you expect this kind of optimism to continue?
I think so. Japan has been probably the more extremist of the central banks, now controlling even the yield curve and buying whatever paper is coming, to the market. So they are fully controlling the GGB market and keep adding liquidity. I think we have seen effect on the currency. I mean, yen has been weakening against the dollar and against the euro or emerging market currencies. I think that the economy is not that bad. Of course, there is no sign of inflation, which is all what central banks are looking for. I think that they are a little bit, stuck in a corner, in the sense that we'll have to see how they will get out of these monetary policies down the road. But for the time being, they are very committed to it, and they are showing the market that they will be there still for some times to come. And I agree with his optimism, at least for the short term.
And finally, we're in Europe. Let's have a look at the ECB. It's been a hectic couple of weeks, lots of stuff happening. But a lot of people, and there's some suggestions now that we may start to see some interest rates going up. Do you think this could happen, and what do you see?
No, I don't think. I think that, ECB was the last of the central banks to start a very aggressive expansionary monetary policy. So I think they are third in the line. Of course, economic activity in Europe has been picking up unevenly, not everywhere, but steadily. So I think that, of course, the risk of deflation has been receding, but we need much more time to have a sustained and more globalized European growth. I think that in terms of inflation, we don't see any sign of rising inflation. Probably, of course, commodities. I mean, oil has been moving down. Other commodities have been moving down. Euro has been going up since the beginning of the year, in between 5 and 10%. So all these will keep inflation in check. I think the Draghi is very committed in the longer term, really to create the better economic condition. So probably we will start just by stopping the quantitative easing and bond buying program, which of course has created some there is a huge amount of bonds that are trading below zero interest rates. So I mean, this is probably it's the end, So this will come, but I don't expect any interest rate rise in Europe, at least for another 18 months.
Let's just quickly finish up on then. You mentioned bonds there. What do you expect from like market equity, bonds, and currency to do in the coming weeks? On
the currency market, it will be interesting period. So we already see much more movements. We see much more adjustments, in terms of euro, in terms of emerging market currency, the dollar, which has been quite weak, let's say, since the beginning of the year. I think it will catch up, the dollar, in the second part of the year. Probably euro will be a little bit softer. Swiss franc has been on the weak side, so I think the Swiss National Bank policy, as we are in Switzerland, is working appropriately. Yen will still be weak, and so I think for currency trader or allocator, it will be interesting months. Concerning bond market, of course, for me is the risky asset, not the conservative asset, which I would not consider in an asset allocation. I think a bond market is at risk because interest rates are, let's say, on the rise. Yield curve are pretty flat, so we could have a steepening of the yield curve. And anyway, interest rates will be more moving up. So I don't think that there is too much money to be made in the fixed income country, and central banks are there. So what will happen if central banks stop buying or reduce buying? This is a big unknown. So that's why I would definitely avoid the stock market, the bond market, and equity market. I think on the opposite side, the valuation are pretty high, but I think that they will still be sustained by a quantitative monetary policy by central banks, and it's probably the only place to be. So maybe there will be a little bit more volatility. We would love to have a little bit more volatility because for the time being it has been very, very, very slow. But it's the place where we are still positive.
Roberto, thank you so much.
Thank you very much, Jack.
With us. It's great to see you again.
Bye bye.
And thank you for watching. And if you like this interview and would like to find out more, be sure to head over to dukascopy.tv.